Hi, this is Jack Schwager. This video will provide you with an introduction and overview to the Jack Schwager indicators, which are only available on TradeShark. I've been very impressed with the ease and flexibility of using the TradeShark software and how TradeShark has adapted their software to incorporate these indicators. TradeShark provides an excellent set of graphic tools to analyze the application of the indicators to all markets, futures, FX, and stocks. This introductory video will give you a sense of the ease and flexibility in which these indicators can be used as trading tools with the TradeShark software. Let's first begin by defining what the indicators are and what they are intended to show. As you can see, there are three Jack Schwager indicators. First, we have the trend weight. The trend weight is intended to capture major trends in the market, with the value of the indicator reflecting the strength of the trend. Second, the overbought oversold is an indicator which acts in a counter-trend fashion, becoming increasingly positive, that is overbought, as an uptrend progresses, and increasingly negative, oversold, as a downtrend progresses. And last, we have the directional weight, which combines the trend weight and the overbought oversold by subtracting the overbought oversold from the trend weight. So for example, if the trend weight is equal to 90 and the overbought oversold is equal to 60, then the directional weight would be equal to 30. For each of these indicators, the value varies between a maximum of plus 100 to a minimum of minus 100. Now let's look at an example of these three indicators and how they interact using the Japanese yen as an illustration. Here we have a one-year chart of the Japanese yen and three subplots corresponding to each of the three indicators. The top subplot is the trend weight, the middle one is the overbought oversold, and the bottom one is the directional weight. We'll discuss each of these in turn. First, let me note though that these black horizontal lines simply indicate where the indicator has a zero value. And to make the visualization easy for the trend weight and directional weight, when the line is above zero, the indicator is above zero, we show it as green, and when it's below zero, we show it as red. And the simplest interpretation of buy and sell modes could in fact be the crossover of the zero line. We'll discuss lots of other methods in the subsequent videos in this series. So let's begin with the trend weight here. Basically, let's start at this transition point from green to red, which is this point up here in the chart. And this is the point where the trend weight goes below the zero line and continues to go sharply below it, reaching a maximum negative level fairly quickly and very early on, actually, in a longer-term downtrend. You could see that the trend weight basically stays well below zero for the entire period shown, and essentially stays in this negative bearish mode for that whole time. Now let's look what's happening in the overbought oversold at the same time, beginning from this transition point. The overbought oversold is essentially at zero and nothing happens at all. In fact, you could see the trend weight in the top plot going to its maximum minus 100 level, while the overbought oversold actually is still at zero. And only then does it begin to gradually move lower. Doesn't reach significant negative levels, say below minus 80 or so till about here, or very well into the downtrend. And from here on, it goes a bit lower and reaches a maximum negative level close to minus 100. And that's the overbought oversold. Now, the directional weight, that is, as we said, the combination of the trend weight and the overbought oversold. You take the trend weight, subtract the overbought oversold, and that gives you the directional weight. What happens in the directional weight? Well, initially it plunges in line with the trend weight because the trend weight moves down, the top subplot, while the overbought oversold is now moving. And we then reach a maximum negative level in both the trend weight and the directional weight. And as the overbought oversold then starts moving negative, the directional weight starts moving up because you now are subtracting some number from the maximum negative trend weight of minus 100. And as the overbought oversold in the middle gets lower and lower, you're subtracting a larger and larger number until at this point we actually have the directional weight go above zero into a buy phase based upon a zero definition line. And as you can see, therefore, there are times where the directional weight, because it's combining the overbought, oversold with the trend weight, can actually be in a buy mode where the trend weight's in a sell mode, or vice versa. Although for the most part, as you can see, they will be in similar directions. So that's pretty much how these three indicators work and interact with each other. We haven't talked at all really much about how to take them and use them for buy and sell signals. We'll cover all of that in the subsequent videos. Let's review a few of the key points about the Jack Schwager indicators. First, they are designed to signal and ride major trends and their overextensions, not short-term price swings. This orientation reflects a belief that the major trade opportunities come out of major trends. Now, does that mean that these indicators are not useful to short-term traders? Absolutely not, which brings us to the next point. Short-term traders can use these indicators in three basic ways. First, to define which side of the market to trade from. Based on analysis of historical price data applied to diversified portfolios over broad periods of time, on balance, being positioned in line with these indicators would have been far better than the reverse. In this sense, empirical evidence suggests a higher probability for trades in line with the indicators as opposed to trades that are counter to the indicator signals. Second, you can combine these indicators with your own favorite short-term indicator, creating a new signal wherein you only take trades when both indicators agree and presumably thereby have higher probability signals. And third, short-term signals that are consistent with strong trend readings in the same direction can be traded in larger size. The next point that is critical if you are applying these indicators to futures markets is that you need to use continuous futures as opposed to individual contracts. Because these indicators require a year or so of data to initialize, and because the indicators are seeking to capture longer-term trends that last many months and even a year or longer, individual contract data is no longer appropriate. TradeShark offers continuous futures prices for every futures market. Here we have an example of a continuous futures chart for the soybean market. As its name implies, this type of chart is constructed by linking together successive contracts. So for example, here we start out with May, we go then to July, then to August, and so forth, moving through time, creating one continuous price series. The key thing you need to know about continuous futures is that prices are linked together so that when you go from one contract to the next one, any price gap is eliminated. This avoids showing fictitious price swings that would not have occurred in your actual equity. So the continuous futures price chart accurately reflects changes in equity and true price swings because it eliminates the price gaps at rollovers. 4. These indicators are based on algorithms that were developed 25 years ago and are not fit to the recent data. Now, why is this important? Because this approach enhances the robustness of the indicators. That is, indicators that are predominantly profitable over broad periods of time without fitting to the data are more likely to remain net profitable in the future. In contrast, indicators that are overfitted, for example, designed to optimize recent data performance, will look great for this past period, but will be less reliable in the future. 5. The indicators can be used either as aids to discretionary trading, for example, as to what side of the market to trade from, or they can be used as the basis for systematic trading by using the indicators for trading signals. 6. As you will see in the remaining videos, when applied to generating buy and sell signals, each indicator has adjustable thresholds and several other options such as early exit, early reversal, long only, and these options can be either turned on or off by the user. Now, this flexibility allows users to tailor indicator signals to fit their style. One of the key lessons I learned from interviewing all the market wizards was that they all developed the methodology that fit their personality. So hence, building flexibility into the indicators with the TradeShark software was a key goal that I had in developing these indicators. 7. The indicators provide a perfect complement to the short-term predictive indicators in TradeShark. In fact, one such combination of indicators is the basis of the dual trend signal, which is featured in a separate video. Just to give you a feel for this indicator and how it can be used to trade the markets, here is a preview from that video which shows the dual trend applied to the soybean market. This chart illustrates the dual trend applied to the soybean market. The chart shows the two indicators that make up the dual trend as subplots and shows a strength bar underneath the price chart that shows the status of the two indicators. When you have two green horizontal bars, that means that both indicators are bullish. When you have two red bars, as we have for most of this period, that means that both indicators are bearish. When you have a yellow bar, it basically means that they are neutral, basically in opposition to each other. In cases where you have a single bar, such as here, it means that one indicator is bearish in this case, and the other is neutral, or when it's one green bar, one indicator is bullish and the other is neutral. Now, there are several characteristics about the dual trend that you can kind of see in this chart. First, note that the dual trend tends to be basically in line with whatever the major trend is. So during this period, we're essentially either long or neutral. And during this period, when the market's in a major downtrend, we're basically either short or neutral. Now, a short could be a single short, it could be a double short, or it could be neutral, but there are no longs in that particular phase. The next point to note is that the dual trend is pretty good at getting out of trends not far from where the major reversals are. So for example, here where we are going from long to a short as a major trend, you could see we hit the yellow right here, which is very early in the downtrend. And similarly, as we go through this market in a general bear trend, we switch over to neutral right here, which is again extremely early in the beginning of the next uptrend. And the last point to note is that the dual trend will often be able to shrug off or avoid whipsaws during minor corrections in a major trend. So at these points, for example, we may be going neutral, but we're not going long on these small rallies. This completes the video 1 overview. There are a total of 8 videos in this series, which are listed in this slide. The next video, video 2, will take a close look at the trend weight indicator and how it can be used to generate buy and sell signals in the market.